Así, ¿no? So good morning, everyone. First of all, to thank Christian for once again having us here in this wonderful event. Always a pleasure to be present. And my name is Diogo Pimentel. I work at Magallanes Value Investors. We are a value investor asset manager based here in Madrid. We were founded 10 years ago, and we manage roughly 3 billion in pure European equity funds. So moving now to our investment idea, we want to present Brenntag. Brenntag is a German company founded more than 150 years ago. It's the market leader in terms of the chemical and ingredients distribution, present in more than 70 countries. You can see here the 2025 figures. It has roughly 8.5 billion market cap, and you can see the multiples that the business are trading: 7 times EV to EBITDA, 12 times PE, and 4 times dividend yield. And now I'll try to explain you guys why do I think this is a great opportunity. First, in terms of the shareholder structure, there's something that we like, an alignment of interests. Here, the biggest shareholder, it's Kuhn Holding, the German billionaire. He's the biggest investor, I would say, in the logistics companies in the world. He's the owner of Kuhn & Nagel, it's Hapag-Lloyd, Lufthansa, so he understands the logistics and the distribution business. Then you have Artisan Partners with more than 10% stake. This is a fund. And then you have two activist shareholders, Primestone and Engine Capital, that have pushed for several changes in the company in the last couple of years. In terms of geographies, it's a global company, but as you can see, the biggest geographies is the US, North America with 50%, and EMEA with 41%. And in terms of end markets, very well diversified. As you can see, the end markets, the biggest it's food with just 16%, and all the other end markets weight less than 10% of their sales. In terms of this presentation, the animations don't seem to be working. Oh, don't worry. So here, in terms of the business model, the Brenntag is the undisputed global leader in a highly fragmented market. In the graph that you can see below, it's the market shares of the biggest players. Brenntag is the leader with just 5% global market share, and the top 6 players in the industry have roughly 11% market share. So there's a huge roadmap to consolidate this industry. And then the business model is separated in 2 different subsegments, the industrial one and the specialty segment. And Brenntag is also the market leader in both segments. In the industrial segment with roughly 77% market share, and in the specialty segment with 5% market share, and is the leading consolidator in this industry. Now I'll try to explain the distribution model. I think it would be more interesting with the animations, but let's try this way. First of all, how does the chemical distribution works? First of all, the chemical suppliers, the chemical manufacturers, the big BASF, the Dow Chemicals of the world, they distribute directly to the biggest customers. This represents roughly more than 85% of the sales of the chemical distribution. But this only represents 15% of the clients in terms of the number of clients. Then you have a long tail of small customers that represent roughly 15% of the market, but they are 85% in terms of the number of clients. These are small and medium customers that are complex to be served by the large chemical players, and so they are served by the distribution companies. In the below, you can see what is the typical distribution model of a company. Here you have of Brenntag is basically B2B services with a lot of economies of scale. So they connect the chemical producers to the small chemical users, and they have a wide range of services. Of course, the smallest competitors don't have such a big roadmap of services, but they have some of them, and Brenntag is integrated and offers all this service to its clients. The chemical distribution that is outsourced is roughly 440 billion euros a year. What are the big industry trends on the chemical distribution? First is outsourcing. Biggest players every year rely more on outsourcing it to the small independent distribution like Brenntag. Then you have all this economic and geopolitical uncertainty that are pressuring or impacting supply chains. So you need expert companies doing the last mile distribution, warranting that you receive your product on time. So this is a big trend, a big niche market for the chemical distribution. So you have increasing regulation, trade barriers. We saw it yesterday. So this reinforces this business model. Then we have a bifurcation of services that you have to adapt to your client needs. You don't have just one business model for both industrials and specialties. The industry is separating for the industrial side and for the specialty side. And then you have a big consolidation given the huge fragmentation of the industry. What's the growth opportunity? First, you can see that global distribution is outperforming the chemical manufacturing. And this is a different business model. The chemical distribution grew from 2015 to 2019 4% a year against 2.6% from the chemical manufacturing. And for the next 3 years, it's expected to continue to outperform, to grow 3 to 0.5% a year against 2.2 to 4 for the global manufacturing. This is substantially different business models in terms of the global chemical manufacturing and the chemical distribution. The chemical distribution is pretty much cyclical, so it's a very resilient business model across the business cycle. The commodity prices don't matter. The service, it's the chemical price, it's a pass-through for your clients. What you sell, it's the chemical price plus distribution fee plus a value-added fee. That's what they charge to the clients. And Brenntag is uniquely positioned to benefit from these trends for the next years. First of all, trying to explain how they are organized in terms of the business model. You have two businesses, the industrial part and the specialty part. The industrial part is more the typical what we could think of in terms of chemical distribution. It's the big trucks delivering acids, solvents, lubricants to small customers. Here, your competitive advantage comes from the scale. You have to have big scale, big global access to suppliers to get you the better price. And then you have to be the most cost efficient in terms of last mile distribution. So here the pricing is a commodity, and in terms of the prices here, you're talking about a euro or dollar per ton you distribute. So it's more a commoditized type of business. They are more exposed to North America than Europe, and they are growing now in Asia and Latam. And then you have the specialty business. It's the most interesting part. It's where you have the higher margins, and it's almost like a consultancy business model. Here, you have to partner with your clients to develop the products. The products are more or less tailor-made for each client. You partner with the suppliers to have exclusivity distribution agreements across the world, and here the innovation matters a lot. Here, this is a very asset-light business model, and in terms of pricing, here we're talking about euros or dollars per each kilo that you distribute. Is this now entering in detail in each of the areas in the Brenntag Essentials? I'm not spending a lot of time. This is a very well managed division. It's the story, what we think will drive the re-rating of Brenntag is not the Essentials business. This is roughly 70% of the sales and 60% of the EBITDA. They are the market leaders, 7% market share. And as you can see, they have been doing very well. They have been outperforming the market, a very stable business model in terms of both gross margins, in terms of growth, and in terms of EBITDA evolution. They have a roughly 7% EBITDA margins. We believe they can expand their margins by 50 basis points in the next years, and they have several initiatives like the volume growth, the last mile optimization, regional sourcing. This is mainly getting more cost efficient, reducing the number of warehouses, having global sourcing contracts. On the other side, you have offsetting all these. You have some cost inflation, mainly transportation and labor. It's more labor intensive. And on top of this, you have additional M&A. The company targets 5 to 7% EBITDA growth per year until 2027. We are slightly below this, around 3% before M&A. And now entering what we think it's the lever to create value to shareholders. It's the Brenntag Specialties division. This represents roughly 30% of sales, 40% of EBITDA, because it has higher margins. They are the market leader, 5% market share. And this area, this division, is more exposed to the most attractive areas or segments or sectors that grow more than global GDP, especially life science, which is nutrition, beauty and care, and pharma, and material science being water treatment or lubricants. This is the areas that show best profitability in the chemical distribution and higher growth. But unfortunately, Brenntag Specialties has not been able to capitalize from these market trends. Now we're trying to explain why they have been underperforming. And we compare their performance with the two pure play listed here in Europe, Azelis and IMCD. First, in terms of gross profit, in the last 3 years, you can see that the Brenntag in blue in the left chart has been growing below IMCD and Azelis. On the right side, you can see that they have been growing below and with less profitability. You can see that Azelis and IMCD are quite profitable, both generate 11.5% EBITDA margins. That compares with 8.5% EBITDA margins that Brenntag Specialties has. And of course, this performance gap is reflected on the valuation of each company. You can see that Brenntag is trading at 12 times PE, but you have Azelis trading at 15% and IMCD trading at 20%. What's the good thing about this? We have met the company, we have discussed with this. They have announced a public restructuring program for the specialty business. They have been very pragmatic. They are not in denial. They recognize the problem that they have and launch a big problem to address a big program to address this problem. This problem first comes from the legacy business. The specialty division is a new division inside the chemical space, and they used to approach this with their legacy approach. They were distributed by markets. They had the same commercial team that was selling to the specialties, was selling to the essentials. They were not focused. They understand they have to focus. They have announced already a separation of the activities, and now they are focused by end markets, life science and material science. Then they also have separated the supply chain and their supplier base. They no longer discuss supplier contracts as a whole. Now each business defines and negotiates their own contracts. This is allowing the company to get exclusivity agreements, new contracts, and to leverage the power that they have, because they have the biggest company, they have the best scale, they have the higher scale on the space, but they didn't have the best track record in terms of commercial team. They are addressing it now. In terms of the plan that they are announcing, first of all, it's pricing and margin management. They have announced the DIDEX plan and the digital data and excellence program that should allow them to have better pricing, tailored pricing to their clients, and in individual price and better pricing optimization in each moment of time. They have announced a cost-cutting efficiency program. They are focusing just on the areas that are more profitable and where they want to grow. They have changed their portfolio considerably. A lot of products that were considerably in the past were considered specialty products. They have moved them to commodity products because these are not really specialty products, and they are starting to launch a lot of new exclusive supplier agreements with suppliers that will allow them to distribute in exclusive basis value-added products. And then they will add a lot of value-added services like mixing, blending. They are very strong, for instance, in the food, in the nutrition area, but they don't do this service for the beauty or for the pharma subsegments. And then you have the M&A. M&A here, the priority is to fill the white spots they have in terms of geographies and in terms of subsectors. In terms of subsectors, especially the pharma business is where they want to grow. And in terms of geographies, they want to grow outside Europe, mainly North America, LATAM, and Asia. And they have a plan to invest 400 to 500 million a year in bolt-on acquisitions for the company as a whole. We believe if they can deliver this restructuring of the company, that's what will drive the re-rating of Brenntag shares. The company is targeting a 7 to 9% EBITDA growth before M&A. We are more conservative than that. We are discounting 80 basis points improvement in margins. That should translate in a 5% EBITDA growth for the next years. Then in terms of the balance sheet, they have a very strong balance sheet to 1.9 net debt to EBITDA, in line with their target. But what I want to highlight in this slide, it's the counter-cyclical business model that has been attracting a lot of private equities to the sector. We have seen a lot of private equity transactions in the sector, and it's this counter-cyclical nature of their working capital. You can see that on the graph on the right. You can see whenever there is uncertainty, where is macro deceleration, there is a huge destocking, and these companies generate a lot of cash flow. You can see that in 2019, 2020. You can see in 2023, when the business is growing, of course, they consume working capital, but whenever there is uncertainty, these companies generate a lot of free cash flow and deleverage very quickly. I think that's very interesting and unique in terms of this business model. And looking at the company targets, the company is targeting a 7 to 9% organic EBITDA growth. That's coming 2 to 4% from the global chemical markets growth. Then you have the 1% additional from the higher level of outsourcing. You have a 2% from all the growth initiatives that they are implementing, and then another 2% in terms of the cost initiatives that they are implementing, and this should be complemented with an M&A of an additional 3% that would give a total EBITDA growth of 10 to 12% until 2027. As I said, we are on the conservative side. We are on the 4 to 5% organic EBITDA growth until 2027, and we prefer to wait to the delivery of these targets to be the best case scenario. Now you have the valuation. We think the stock as of today, without any improvement, are already cheap. In the current scenario, no improvement, we have a 17% upside in terms of the current share price. Our base case is that they improve the Brenntag Essentials EBITDA margin by 80 basis points to 9.3% in 2027, and that will lead us to a price target of around 100 euros. It's 70% price appreciation, and the best case scenario, if they can improve the EBITDA margins to be in line with the best in class peers in Europe, the shares could more than double, 123% upside in that scenario. And in terms of risks, of course, global macro environment, specialties turnaround. If they are not able to deliver this turnaround, of course, the re-rating of the shares will not happen. Value destroying M&A, if they decide to do a big, large-scale M&A, I think that's not the track record that they have, is small bolt-on acquisition, FX, mainly the US dollar, cost inflation, until now it's not a big problem, but if we have an escalation of cost inflation or wages or transportation costs, that could be an issue. And I'll leave you here just a wrap-up of our investment thesis. It's a very attractive valuation for a compounder. We believe it's trading at less than 6 times a normalized EV/EBITDA and a more than 10% free cash flow yield for a global leader in the sector, that you get exposure to the turnaround of the specialty segment and exposure to the recovery of the global GDP. Okay. Thank you, and I'm hoping to
thank you very much.
Hear your questions.
Any question? Here you go.
Excellent presentation, Diogo. Just have a couple of questions. First, in specialties, do you know if Brenntag has R&D centers where they develop the compounds to serve the clients?
Yeah, that's one of the biggest competitive advantage. They have a network of 17 labs around the world where they partner with their clients, and that's a big competitive advantage that they have. They have the scale, and they are focusing a lot on this exclusive and these partnerships with their clients to develop these products. And now they are improving their track record in terms of the commercial team. That's what they need. They have the scale, but they lack the commercial track record for a supplier to trust on them and give them exclusivity agreement. That's what they're doing. For instance, the big difference with IMCD, it's IMCD, 80 to 85% of their sales come from exclusivity products. So that's what they are working. That's where they want to go. But of course, this takes time. You have to sign a long-term contracts. We have to wait for the legacy contracts to expire and to renew to new products.
Okay, excellent. And just a final question about M&A. I guess most of it, they do it in specialties. Yeah, not in the commodity part, but in the specialties, right?
No, the essentials part of the business, they want to grow in APAC ex-China, but in China they are already very strong. So the APAC, it's small bolt-on acquisitions. And in the Europe or the US, they want some infrastructure, strategic infrastructure. For instance, a company that has an access to a port or a chemical tank where they can warehouse. That's what they want. But the focus is bolt-on acquisitions in the specialty part of the business.
And do they speak in their reports or when you talk to the company? Do they talk about the cultural fit when they are looking for doing M&A?
I think when they look at M&A, it's what I try to explain. They want bolt-on acquisitions to fill the white spots that they have in the portfolio. First of all, in terms of products, and then in terms of geographies. In terms of products or sectors, they want to focus on pharma. In food, they're already food or nutrition, they are strong. But in the beauty segment or the pharma, they are not very strong, neither in sector, neither geographically.
Thank you. Thank you, Diogo.
Anybody else?
Hi, thanks, Diogo. Do they have any risks in terms of dangerous chemical transport, something that would be like a reputational risk if it went wrong?
Yeah, that's the risk. They never have a problem. They are insured against that. They have all the mechanisms. If there is a spill on one of their warehouses, to be contained, to not go to have a spill to get to the environment. But then, of course, they transport dangerous chemicals. Of course, there's a risk. They are insured, of course, but it's a risk. But they have, it's a truck. They have lots of trucks. It would be bad luck if something happens to several trucks or at the time, or they have several warehouses around the world. They have more than 600 locations around the world. So each location is relatively small for the company as a whole.
Okay, thank you so much.
Thank you.
Stephen?